Bloomberg Audio Studios.
Podcasts, radio, news.
We'd like to welcome San Francisco Fed President Mary Daly to our studios here. Thank you for joining us. Before we get into the cycle question that Tim raised, I want to ask you if you're on the same page with the chairman. You and others had said you wanted to see more data, and we still have a jobs report and CPI report, but it looks like a cut is now all but certain.
Well, to my mind, we've been on this path of ready to adjust policy rates for several months. We just needed to get a little more confidence that inflation was truly on its path to 2%. And I wanted to see the labor market come into balance, but I think that's completely happened. And the risks to our goals are now balanced, and the time to adjust policy is upon us.
Is there anything that could derail a cut in September?
To my mind, that would be hard to imagine at this point. I do see that adjusting policy is appropriate. We don't want to get ourselves into a situation where we're keeping policy highly restrictive into a slowing economy. And remember, every time inflation comes down, the policy gets more restrictive. And I think that's a recipe, if you will, for over-tightening and injuring the labor market and growth.
Well, the chairman and basically the Open Market Committee said coming out of the meeting that the downside risks are greater to unemployment than to inflation. How big are the downside risks to employment right now?
Well, that's the very important question. And so we definitely have to keep that in mind because, as you know, the labor market, when it starts to adjust, often has adjusted abruptly and significantly. But right now, we don't see any signs of that. You look at initial claims for unemployment insurance. You look at early indications of layoffs. They're just not present. And so that's not giving us any signs that there's a deterioration. Importantly, as you know, the Reserve Bank president spent a considerable amount of time talking to contacts, businesses, workers. We're really not hearing signs that firms are poised for layoffs. What they are doing is managing headcount, making sure that they really want to refill a job before they do it. But at this point, I don't see any warning signs of weakness, but we want to make sure that we are adjusting policy as we go so that it's ready for the economy we have and for the economy we're likely to get, and ensure that we don't end up in that situation where we see real weakness.
All right, let's talk about tactics. Markets are now pricing 100 basis points in cuts by the end of the year, but there are only 3 meetings left, which would imply at least 150 basis point cut. Do you think the markets are wrong, or is it a good possibility we see a 50 somewhere?
Well, I think everyone's looking at the economic projections and then making a decision. For me, what I'm going to be doing is looking at the incoming information. As you said, we have another CPI, another labor market report, discuss with my colleagues, talk to our contacts, and fashion the policy that's right for the economy that we see. So it's too early to know exactly what the tactics will be. We do know one thing. The direction of change is down, and we need to do it in a way that is responsive to the economy and not let the economy get in a position of weakness.
Well, let me quote the Fed back to you. If the economy evolves as we expect, as you always say, would that imply a 25 basis point cut in September versus 50?
So I think of it as scenarios, if I may. So the scenario that is my most likely outcome, and what I see in the data and the projections, is that we continue to get gradual slowing in inflation, and we continue to get that steady, sustainable pace of growth in the labor market. If those things happen, then adjusting policy at the regular normal cadence seems reasonable. But if we see a further deterioration, or we haven't seen any deterioration yet in the labor market, if we should see deterioration or any signs of weakness, then being more aggressive to ensure that we don't see that, it would be appropriate. So I think it's too early to know, and I don't want to make a declaration when none is necessary. The direction of change is down, and the time to adjust is now, in my opinion.
Some of your colleagues at the regional banks told me in Jackson Hole that they want to see a methodical, step-by-step process, and that companies want to see that as well. But markets are reading into a little bit of what Jay Powell said when he did not say, because he didn't use the word patient. Do you think that there is a sort of bias to maybe do more if the labor market is a little bit weaker than anticipated?
Well, let me speak about myself, and I see further signs that the economy or the labor market is slowing as unwelcomed. And I do not want to see that. That's a That's not what we're looking for. We're looking for, and the chair said this in his speech, we're looking for inflation to come down, can be sustainably down to 2%, and for the labor market to stay right about where it is. We don't want to see additional weakness because that's actually what we're trying to prevent. Ultimately, we have two goals: price stability, full employment. We're trying to get those two goals to simultaneously exist, and adjusting the policy rate to ensure that happens is what we will need to do. And so I will back away or stay away from any kind of playbook or program, and instead continue to be data dependent and recognize policy adjust to the data as it comes in.
Is this probing the economy, or are you basically setting out on a path to neutral now?
I don't think we want to declare that we're setting on a path to neutral because we have a lot of uncertainty still. But it is definitely the case that we have a policy rate that's highly restrictive and that we need to right-size it for the economy that is slowing. Policy will remain restrictive even when we make adjustments, and that means that we'll continue to put downward pressure on inflation, continue to have growth bridled, but we want to make sure we don't overdo that and find ourselves with an economy that's weakening when weakening isn't warranted. We are getting inflation to come down without instilling any weakness, and I think we want to continue to focus on that.
Well, do you have an idea of where you think neutral might be? Is potential growth faster now than it had been, and will it stay that way?
You know, the neutral rate of interest is of course, constantly debated, and people are thinking about that now. For my own self, I think of it as if we came in to the pandemic at a 0.5 real neutral rate, I can see it being as high as 1 now, and we will find that, you know, as we go. I think the really relevant thing now is that even when we make adjustments to the policy rate to make sure it's right, we will still be in restrictive territory, and we have a long ways to go before we get to, you know, 2.5 or 3 in the nominal neutral space.
Well, we have a new summary of economic projections in September. Where are you going to put your growth forecast for the next couple of quarters?
I really think that growth is around trend. My trend is, you know, like most people, between 1.5 and 2%. And I will work with my team, look at more information and things before I write down any numbers. But I think growth at or a little bit below trend is what we're seeing. And the labor market's now in balance. And we're just trying to sustain those conditions while we see the rest of monetary policy take effect on inflation and bring us into that 2% target.
Well, if you've got 2% growth, the market is looking for something like 300 basis points of cuts by the end of the next 2 years. Are you looking at getting inflation down low enough to make that make sense?
We have to get inflation down to 2%. That is the commitment we've made, and I believe we have the tools and the will. I think that will is the second part that's really important, the will to do that. But the goal has always been, since the beginning of this effort to bring inflation down, to do it as gently as we can, not injure the labor market in any way that's unnecessary. We've shown so far, the data have shown, that we were able to bring inflation down through improvements in supply and restrictive monetary policy, and the labor market has not faltered. That is still the goal. I mean, ultimately, people want a sustainable growth rate, a sustainable unemployment or employment picture, and 2% inflation. So there's a lot of work to do to get there, and we're far from declaring victory, but we have the tools and the will to do it.
What are you telling people who look at the SOM rule, and we've passed that, so they're putting up umbrellas because they think a storm is coming?
Well, you know, these historical regularities is what the SOM rule is based on, but other different mechanisms. They're all about what has happened historically. And there have been, and I think this is often forgotten, there have been a couple periods in our history where unemployment rose, but we didn't end up with that sharp spike in unemployment and the labor market didn't deteriorate. You have to look back to the 90s and the 2000s for that. But these things are possible. And importantly, we do need to look under the dashboard of the headline indicators, you know, employment growth and unemployment. We have to look underneath that, say, why are these things happening? We've got improvements in labor supply. We really have to put this whole constellation, as, you know, we famously said, I think Vice Chair Yellen at the time said during the financial crisis, we need this aftermath, we need a full dashboard of labor market indicators. As a labor economist, I definitely look at the full dashboard. And the time is now to talk to our contacts, talk to workers, talk to firms, look at the dashboard, and make the right decision.
Now, the Fed said it would end QT before cutting. You didn't want to do both at the same time since they kind of work in opposite directions. That, I assume, is off the table now?
How do you mean?
You're going to keep QT running even when you're cutting rates.
I see that, what we ultimately announced is that we're going to reduce the size of our balance sheet, and we are going to adjust policy. Both of those, I think of it a little differently, which is why I asked for clarification. I think of it as we are normalizing both the balance sheet and policy rate at some point. We're not there yet. We're could start that soon. And both of those things are consistent with bringing our toolkit back into its normal position so that we're ready going forward. But while we do that, we have to continue to remember that we need to bring inflation down fully to 2%.
Well, you worried, I didn't get a chance to ask you this last week, about the revisions to the BLS establishment survey being so large and suggesting that maybe, not through any fault of yours because you work with the data you have, but that you might be behind the curve.
Periods of adjustment, large adjustments like these, I started working at the Fed in 1996 as a labor economist. This was a very traditional kind of adjustment that would occur. It often occurs at inflection points in the economy that these adjustments are larger, but we have a feeling that these adjustments are coming. We do our own estimates. We know adjustments of some size are coming, and it is why you don't look at just employment growth, just the payroll employment growth. We look at the household survey, which tells us other indicators. What was really interesting, if you look back over the last year and a half, is that these numbers of job growth were feeling inconsistent with the rest of the indicators. And so I think these adjustments are just bringing it back consistent with the other indicators in the labor market. Bottom line is people are still getting jobs. People are still coming into the labor force, usually a good sign that jobs are available. Initial claims for unemployment insurance haven't really moved up in a sharp way, and firms are interested in growing their businesses consistent with the economy. So I think that that's important for us to look at, but we don't want to get over-rotated on that one adjustment when we have so many pieces of information we can look to.
Before I let you go, one last question. We've got the framework review coming up this fall. What would you like to see it look at?
Well, I'll be debating that with my colleagues and discussing that. I don't want to front run what we're doing. What I really want to focus on, though, in the framework is that, we've made a commitment to review our framework every 5 years. That's a very different process than the one I grew up in. And I think it's really important that we look at the information we have and we think about, okay, does that affect how we use our tools, what our tools should be, and that we're transparent about it as we were last year. Those are the components that are really important to me. And I'll delay specifics until I've had a chance to talk to my colleagues about that.
All right. Well, thank you very much. We'll have you back to tell us once you get into that.
That seems great. It's a commitment.
Mary Daly, the president of the San Francisco Federal Reserve Bank.